To the extent that we've actually seen some very relevant players that you and I know and respect who've just said, look, enough's enough, this is not the game that I play, and I'm at the point where I've made enough money that I'll just take my ball and go home. I've seen that happen multiple times in the last couple of years.
Well, what I would say is the most important thing over the last 3 years is people know that there has been a dramatic shift in the information ecosystem.
Right.
And how the sources of information, and when you go talk to the large data and news organizations, this notion that they are able to truly understand the market as a practitioner, everybody knows is inexact now. Mm-hmm. So while Twitter may not be the best forum for every investor, it has sure delivered more meaningful, higher quality, timely information than anything we've ever seen.
By far. I mean, I like to say Twitter is the new tape for a reason, because
sure.
you know, at least the first decade of my career, I would literally stare at the tape. And you know, I'm pretty sure that Steve Cohen stares at the tape still today. Mm-hmm. A lot of people have recreated their own ecosystem or tape, and this includes Twitter. Now, the problem with this is that you have a tremendous amount of information, but you don't have specific curation of that information. How have you felt about who are supposed to be the right sources
sure. versus
the sources you found to be relevant? Can you kind of talk
sure.
about that?
I immediately saw Twitter as a venue, as an avenue for much shorter time frame, risk-relevant, thematic, market-related, commentary. And once again, I understand that every investor has a different schedule of values. They've got different objectives, different durations, all these different. But I can tell you this: as I started to write more and more on Twitter, I had wonderful feedback from all different types of individuals, clearly institutional investors. And I would always say to people, you never know who somebody with 50 followers is. And that do not...
Isn't that the truth? There is so... Because the buy side in particular, and most of you who are watching this know this, but the buy side can't, in many cases, communicate openly with their name on Twitter. But they will be that guy or gal on Twitter that has 20, 50 followers, and you don't know who's coming in hot with something that could actually really matter to you.
Right. I was always told when I was being brought up on Wall Street that the client has to trust you.
Right.
The client has to like you, and you have to deliver excellent service. Mm-hmm. So when you look at those three variables, I wound up writing for a little bit over 2 years. I really had wonderful relationships, much to my surprise, with all different types of investors, students, young investors, RIAs, professionals, all different types. I thought, isn't this wonderful that I can expand my ability to have some level of conversation? Mm-hmm. And again, I tried to be factual. I thought the message was really data dense, that there were pieces of information that could be delivered in short form in a timely way that mattered to people. Mm-hmm. And I found the more I wrote, the more I learned. I wasn't perfect.
No, but this is the point. Like how this conversation started with, it's my job and your job to learn and unlearn and relearn as fast as we possibly can. And what this is really a Trojan horse in learning. Now, how do you take that? Because that's a very progressive thought. This is what you and I have found a tremendous amount of success and value in. What about all the other stuff? There's what I affectionately call old media, old Wall Street media. Mm-hmm. What do you think about that? What is their strategy from what you can tell on Twitter?
This is actually interesting. 2 weeks ago, I was up at the MIT Media Lab, and I watched the Bloomberg presentation.
You're just hanging out at the MIT Media Lab.
Well, I went specifically to see the upper levels of Bloomberg present their view of the evolution of news and data.
I'm sure it was riveting.
Well, it was fascinating. A number of years before, Joey Ito, the head of the Media Lab, was being interviewed by a professor from Columbia, Emily Bell. And she said, why do journalists lag software engineers in innovation? He said, because the design technology function isn't bundled together. The birth of Twitter wasn't an editorial birth, it was a technological birth.
Exactly.
They wrote code before they wrote stories. And he said the essential bundling of design and technology allows the speed of iteration to accelerate. Mm-hmm. And he made the comment, which was pretty interesting, he said, journalists going forward need to do more math. Now, he wasn't being derogatory. He was simply saying, in the world of financial practitioners, I desperately need to know what's going to happen next.
Yep.
And I think one of the things that Twitter, the social media tail that is wagging the traditional media dog, one thing that they don't in any way, shape, or form have the equipment to do today is have the right editors of expertise bundled with this technology support to be able to create the output, the content that will be delivered in a timely way over time. So, we kidded last year that 2013 was the year of separation. Well, I actually think now that there's going to be a large step function in the value providers and everybody else.
Well, this gets to, and you appropriately nailed that. It really was the year of separation where you could see the sources on Twitter specifically divide, and you see that higher value content start to rise. And in many cases, I actually find a lot of value in contra-signals. There's a tremendous amount of value in people who think that they know something that don't know. Like, you can build a lot of behavioral angles here.
Sure.
The value chain is really getting richer. Now, when you think about that information, like, why does this all matter now? Why does this step function matter now?
Right.
And why won't it take 3 or 4 years?
Well, as we were discussing before, everybody's at a ZIRP party, a zero interest rate party, and the challenge, the challenge is being close enough to the door in a meaningful way. Everybody understands. And part of the challenge of the open forum of Twitter is there's all these different time frames that overlay commentary. So often, many people are talking about different things, and they're talking at each other.
And they take it quite personally because you're talking about a position that you may have the opposite position of somebody, or whatever it may be. But time is not always concurrent with when that's thought.
So my job as a private investor is to somehow navigate this unbelievably complex, difficult to understand world in its brittle fashion, the complexity of all these different manipulations and structural changes. I've got a real family, I've got 3 beautiful kids, I pay expenses across 21 different categories. I'm always stunned.
You need to get paid.
I need to get, well, but I can't fall off the bridge and not come back. So I'm always a little bit early in reducing risk when I think there's an ability for me to sidestep what I think is a meaningful deviation. So the challenge is, who are the sources that allow you to stay informed and aware enough as the game is unfolding, and then, the story of 2000 and then really 2008 was having the courage to step away from the party at some point prior to the start of 2008. Like I said to you yesterday, when a friend of mine met with Bill Ackman, and he showed me the Who's Holding the Bag slide deck in May of 2007, it scared the hell out of me. Because it displayed to me complexity and ownership of assets that I had a fair idea of when the acceleration started in the price of those assets, what the impact was going to be.
It's so true. If anyone's ever worked in the bigger room, you know that at some point, even though it doesn't sound maybe legal or whatever the verbiage may be, you actually have to front run the behavior of the room. So to be near the door, you don't want to be near the window. It's elevators up and windows out if you're on the wrong side of this party. If you're hammered out there with ZIRP muscles, and you're just tweeting away saying, you and whatever Einhorn on the bubble thing, you have a tremendous amount of value here where you have some very competent and credible and established investors who are going to give you the signal, the time that you need to de-risk.
Sure.
That's never happened before.
Well, again, as a private investor, it is absolutely essential for me to keep my balance. I can't, over the course of long duration, multi-cycle, episodic volatility, lose my balance, because as you and I know, the quality of people's decision making deteriorates with the acceleration of their NAV on the downside, which means, in simple terms, bad stuff happens when markets go down quickly.
Well, I think that concept in general, because old media and old media finance doesn't have any track record protecting people for the downside, the drawdown risk, the sell signal, the get out. And sometimes you get, like you could see this most recently, David Einhorn said, look, I think some of these social media stocks are the prelude to a maybe ugly kiss. And really, this is the kind of thing that the media takes and almost makes fun of. It's interesting to watch when it's such a rich signal and such an interesting perspective when combined with the other signals.
Right, but when you think of the amount of capital that has ingrained into it, it's not timing the market, it's time in the market.
Yeah.
And ultimately, if you're going to change your mind, make sure you don't do it frequently. Mm-hmm. That's a challenging position.
It's very tough.
And I know that there's a lot of moms and dads, real families, in the 2002 period, and then in the 2008 period, where really they learned exactly the cost of what that anecdote was.